I want to talk to you about a really basic rule that everyone should understand before they start investing. That is the rule of 72. If you don't already know it, the rule of 72 is really easy, and once you understand what the rule is and what it's intending to show you, then it's very easy to use in practice, and you can easily see how it will help you become a better investor. So let's go ahead and dive right into what is the rule of 72. Basically, the rule of 72 is the number of years that it will take you to double your money at a given investment return. So let's say you have an investment that says it's going to pay you 10% returns on your money invested. That means you can use the rule of 72 to approximate how many years it should take you to double that money that you've invested at 10%. To do that, you would simply take 72 divided by 10, which is the return on investment. It's really that easy, and once you understand it and understand what it's trying to show you and how important this rule is, it's really powerful as far as teaching you how to invest your money and how important it is to take some risk and to take calculated risk when you're making investments. Let's look at a few examples of how the rule of 72 would work in practice. So let's say you have an investment that promises a 2% return. 2% by applying the rule of 72 means that it would take you 36 years to double your money. So that means if you invested $100,000 in some sort of asset that's giving you a 2% return each year, it should take you 36 years on average to double that $100,000 to $200,000. So if I invested $100,000 in year one and then kept that invested at earning 2% returns, in year 36, that $100,000 should now be $200,000. The same is true no matter what percentage return you're getting. So whether it's 5, 10, or 20%, you just take that percentage and divide it by 72. Here you can easily see the difference between investment returns and how many years it will take you to double your investment. And you can see how drastically different it is based on the higher the return is. So when you're starting with a very low return like 2%, which would probably be maybe a savings account or money market account in a good interest rate environment might be paying 2%. You can see how that is a very slow rate of return and is going to take you a very long time to accumulate wealth in those types of investments. On the other hand, if you look at an investment that's producing 20% returns, you can see how much quicker you can build wealth and increase and compound the returns that you're making from that investment, because that same money making 20% a year will double in 3.6 years. It's important to note that the rule of 72 is just an approximation. It's not an exact science. So don't think that that's exactly the amount of money you're going to have by dividing 72 by the return. Also, we know returns fluctuate every year. So an investment that says it's giving you 20% probably will give you 15 in some years and maybe 25 in others. It's very rare that you're going to get exactly 20% unless it's something like a bond or a savings account or something like that. So understand that this is really an approximation, and it's an attempt to show you how long it's going to take you to double your money if you invest it at that rate. I want to take some time to show you just how powerful this rule is as far as illustrating to you how important it is to take into account returns, risk, and a lot of different factors when you're thinking about what investments to make. I know when I was in my Finance 101 classes in college, one of the first things every professor taught us was that with personal finance, the absolute biggest risk you can make, or the most risky thing you can do, is not to take any risk. So I think this example that I've put on this slide really illustrates that, and you can see how the numbers work out. And so let's say you're someone who's extremely risk averse and you want to keep all your savings in a low interest savings account that earns 2% because you're more concerned with asset preservation and you don't want to take risk by investing in something like a real estate fund or private equity fund or something that's likely to give you higher returns. So you can see that if you take $100,000 and put them into different investments that give you, returns of these 4 buckets, look at how drastically different the amount of money that you're going to make in the long run is. So if I have $100,000 and I invested in something that's only giving me 2% interest or returns every year, then that's obviously, as we saw before, it's going to take us 36 years to double that investment. So when I look 30 years down the road, I only have 181,000 from that 100,000 that I originally invested. So that is a really, really bad rate of return. Anyone who's telling you to invest only in assets that kick off that type of return is not understanding risk and how to invest in a way that you take calculated risk that will help you grow your money in the most efficient way possible. On the other hand, let's say we took that 100,000 and invested it in something that kicks off higher returns like 20%. So what's something that might give us 20% returns on average? That could be some very high performing real estate funds. Usually they're not going to be that high. Real estate funds are probably more in the 10% low teens returns. But 20% could be a venture capital fund. It could be a private equity fund. Those types of investments can kick off higher returns every year on average. Of course, you're taking more risk with those investments, but if it's a good sponsor, if you've done your due diligence on the deal and you haven't just invested with, someone shady who might run away with your money or make, bad decisions with your money, then it's fair to assume that you might get 20% on average on some of those investments. So if instead of investing in something that only kicked off 2% returns, I invested that $100,000 in something that gave me 20% returns on average, then the difference in when I look 30 years down the road is that instead of having 181,000, I have $23.74 million. So that $100,000 that I invested and kept invested for 30 years turned into almost $24 million in 30-year period. I think that's very easy to think about. If you think about someone who is 30 years old and maybe has $100,000 of savings, then why do you want to keep that invested, invest that early? Because that money and those returns, if you can keep that money invested and just let it compound over time, then look at the difference in what your net worth is going to be when you're 60 years old and you're looking to start, slowing down on work and that type of thing. I think we'd all be happy to have $24 million, especially if that only came from us originally investing $100,000 in a good investment that gave high returns. The one thing I will mention is that I think it's a bit unrealistic to expect all of your investments to have 20%. Those are really going to be investments on the riskier end of things when depending on how you think about risk, it's going to be things like private equity funds and venture capital funds. I wouldn't put all of my money in something like that, especially if I only had $100,000. You're going to want to spread it out across different asset classes. So you might be thinking about more like things that are kicking off 10% returns. So that can be something like a good real estate fund or syndication, or even the S&P 500 index fund. That should be kicking off about 10% every year. So you can see that if you invested in something like that, which I personally think is a very safe investment, if you know what you're doing as far as finding quality sponsors, or if you're able to keep your money in the S&P index fund, for example, and not sell when there's market fluctuations, because you have to be prepared to get on the roller coaster there, then the difference is you're going to have, almost $2 million after 30 years. And yes, that's a lot less than 24 million, but it's a heck of a lot better than 180,000. So it's important that you understand the rule of 72, what it's trying to teach you, and why it is so critical to investing and showing you that you need to think about returns. You need to be taking calculated risk, not certainly don't want to be taking unreasonable risk, because you might invest all your money thinking you're getting 20% and lose it all because it was a risky investment. So you need to understand what you're investing in. You need to take calculated risk. You need to understand what those returns are likely to give you in the long run. And you need to think about investing from a long-term perspective. And I think the rule of 72 is a great way to get started, to understand the principle of what the rule is trying to tell you, and to see how it can have a huge impact on your investments in the long run. If you found this video helpful, please give us a like and subscribe to our channel.